Okay, folks, welcome to Thursday night Stock Charts Live. This is where we're going to review the weekly and perhaps, if we get enough likes, the monthly price action of the major averages and some individual stocks. And tonight's focused sector is going to be the software sector. I was asked to do a review of it. I will do that happily. And I'm going to ask you up front if you could like, subscribe. You know the deal. And if you're not currently a member of the Bulls and Bears Banter Forum, it's free for now. Free. Sign up free. I'm going to give you the link. It's going to be right here. There it is. It's right in the chat box. You could use the QR code. You could, if you're on YouTube, you use the link below. If you're on Twitter, link above, blah, 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 blah. I know I need to get one on Facebook. So coming soon. Okay. I'm a bit parched. This is day 3, technically day 4, but day 3 of Sober October. I've been working out like a madman and dehydrated. So what we're going to talk about tonight, again, weekly charts and monthly charts of the major averages. Which way is this market going to go? We're going to talk about seasonality using TrendSpider, their seasonality functionality. So stick around as we go through some chart requests from members. I did not put out a post. As a matter of fact, God darn it, I forgot. Bear with me while we let people populate in here. I will make up this time later on if we go past 7 o'clock. I don't want to do that. I want to do this. Where's my poll? Why can't I do a poll? Create poll. There it is. We only take the chart request symbols from the forum here. So please enter them there. That way they stay consolidated. So let's talk about our week so far. We booked profits on short of Ross stores. We booked profits on a couple of times, traded soybeans, natural gas, made money there. What else? What else do we do? This is soybeans. We booked profits here. That was the entry on soybeans, raw stores. We booked profits there. BHP Bulletin. We shorted it yesterday. Gap down today. Out. Booked profits there. What else do we do? Natural gas yesterday. Soybeans yesterday. All profitable. Raised stops on TQQQ, which is our hedge of our short position on the Qs. So stop loss on TQQQ 67.86. And that's pretty much the week so far, I think. I may have left something out, but that's the week so far. So let's get to it. Let's say hello to folks first. Again, people are wandering in here, meandering in, if you will. Sean, welcome, brother. Hey, Tim, great to have you, my friend. Thank you for the audio check, as always. All right, let's get to it. So let's do a little bit of homework on the week so far. We have you guys are animals. Andrew jumping in there. Cool. All right, so you guys are popping these in there. Good stuff. Sean, perfect. Wasn't Andrew, it was Sean. Okay. All right. So let's talk about the week that has been so far and that the week will be tomorrow, because we have serious economic data coming out tomorrow. So on Monday, a beat on PMI. However, we just like to call this type of number less worse. Any read below 50 is a sign of contraction. The expectation was for 45.3 on the Chicago Business Barometer. Actual came in at 46.6, so less worse, but it's still contraction. On Tuesday, we did the S&P U.S. Manufacturing Purchasing Manager Index. Again, contracting, but it came in slightly less worse. ISM Manufacturing came in worse than was expected. Another report where we're contracting. The economy so far this week, as measured by the economic data that's been reported, contracting. Construction spending, they expected a flat number. They got a negative number, contracting. I don't know what the expectation was for auto sales. However, we did beat the prior read. I don't know if this is seasonally adjusted. So I'm not going to read into that. ADP employment report. This was a very good number. We beat by 23,000 jobs or so. So good stuff there. Thursday, today, initial jobless claims rose by 5,000. That's the first read in several weeks where we had a greater than expected increase in initial jobless claims. S&P final U.S. services PMI. Now, services remain in a contraction. The prior read was 55.4, the revision 55.2. That was for September. ISM services index. That came in better than expected, still in expansion. Factory orders came in horrifically bad. They expected a flat read. They got a negative read by 0.2%. Now, tomorrow, we get what I like to call the pimp Mac Daddy of them all. That is non-farm payrolls coming out. And the number to watch here is this one here. This one matters. Wages. The Federal Reserve does not want to see you making more money. I'm sorry to say that. I'm sorry to say that, but it's a fact. To the Federal Reserve, that means that if you're making more money, that is inflationary. And with all the strikes that are going on, whether it be the longshoreman strike, whether it be the Boeing strike, you have strikes all over the place. Healthcare workers going on strike. What do you think is going to happen to average hourly wages? They're going up. Inflationary. Adjusted for inflation, or in real terms, it may not be that big of a bump, but the Federal Reserve, they don't really care all that much about you or me. They care about skating their way and claiming victory out of the inflation nightmare that they helped cause. They helped finance it, guaranteed. It was truly the Congress that created the inflationary spiral that we saw. But who financed it? It was the Federal Reserve. So a pox on both their houses. So that's the economic data. I'm drinking my zero sugar Canada Dry ginger ale. Delicious. Valuations of the market. Valuations are quite frothy. 36.6. This is a rear view mirror look, meaning it's not forward looking, it is rear view mirror looking. But we're still expensive on a forward looking basis as well. Buffett indicator, strongly overvalued. We remain 2 standard deviations. In fact, greater than 2 standard deviations above historical trend. So we are very overvalued here. Very overvalued. But we have an election coming up. We have silly season coming up, meaning earnings. We have the Federal Reserve cutting rates. What could go wrong? So when this goes, it's going to be catastrophic. But if you're poised, if you're positioned properly, you're going to make a lot of money, because I think 2025 is probably going to be the year from HELL. Let's talk a little bit about the Federal Reserve's balance sheet. So while the Federal Reserve has been talking, and I haven't looked at this yet. Wow. Wow. So while the Federal Reserve has been jacking up interest rates and talking somewhat dovilishly about more rate cuts to come, what they've been doing in the background, and I don't disagree with them. I think they're doing the right thing here, is that they're unloading debt off of their balance sheet. And they did a lot of selling in the past few weeks. So while they were cutting rates from the end of August, they had over $7 trillion on their balance sheet. They still do, but they're down from, they dropped about $90 billion or so off their balance sheet. That's a lot of money. So if you wonder why perhaps you have interest rates, we're going to go to the chart of long-term interest rates in a moment. Why are interest rates on the long end of the curve going up higher? It's because the prime rate, short-term rates, 2-year yield, 3-month treasuries, all that stuff, that's going down. Whereas the yield curve out on the spectrum, out on the 10-year, 20-year, 30-year debt, those rates are going back up. And we'll talk about that in a moment. We'll show you the weekly chart. CME Fed Watch tool. What is the market expecting? Folks, if this tool here did not say 50%, they probably would have cut a quarter basis point last round. However, the market was screaming 50 basis point cut, and that's what they got. Now, going into the November 7th Fed meeting, they're expecting now the probability of only a 63.3% probability of a quarter basis point cut. This was completely inverted this time last week. There was a far greater probability of us getting a 50 basis point rate cut. That is now flipped. So you can see how it's reflected in the markets, where the small caps, they've been dropping like a rock, where the Qs really haven't picked up all that much. The banks have held in there, but you can see how this tool can influence individual sectors. So I'm firmly convinced that if the pendulum begins to swing back into the favor of a half basis point cut, well then, small caps are going to outperform. Now, tomorrow, we get non-farm payrolls. And this is from the St. Louis Fed. And you can see that the gray shaded areas are recession. So, every time that we get a rollover on unemployment, we go into recession pretty much without fail. How are we looking right now? We're still looking on a macro view, a long-term view, very, very strong. The however is that when you take a look at past occurrences of when we rolled over on the jobs data in blue, it's usually in the middle or at the end of the shaded area. So what that means is that non-farm payrolls, it's a lagging indicator. Usually it rolls over after you're in recession. So just by virtue of the fact that jobs data remains, let's go very, very near term. This is a powerful chart. Here's the 5-year view. Powerful chart. So job growth is still strong. The however is that you won't know whether or not we are in recession until we roll over, all right, or we have been in recession. So how else do we know where we're at in the grand scheme of things? Well, let's continue the tour down the St. Louis Fed's data. So this is what you call non-unemployment rate. This is the, I believe, the U3 number. Yeah, U3 number. And you can see that most of the time, the unemployment rate begins to move up prior to recession in gray, right? So the unemployment rate is a leading indicator, letting you know that, you know what, there's something wrong. There's something brewing out there. So where are we at right now? Well, you're not going to see a shaded area yet because they haven't come out and said we're in recession. And the only time they say that we're in recession is after the recession's over. That's just good politics. God forbid they were to be honest with you or me. So this is a lagging indicator and it's moving up, not what you want to see. And this is the U3 number. If you take a look at the U6 number, the unemployment rate is far higher than where we are at current on the U3 number, because conveniently enough, back in the 1990s, they used to use the U6 number, but that became a little bit too, you know what, let's cutesy this up a little bit. Let's no longer count those people that have dropped out of the workforce, or those people that are working part-time, or those people that are marginally attached to the workforce. We're not going to include them anymore. They don't exist. You have to go to the U6 report to get that picture. This one makes the politicians feel really, really good, like they're doing a good job, because this is what CNBC is going to report, a far more benign number than what you would get on the U6 number. So it's simply what they do. They manipulate the data just like they did with non-farm, non-farm payrolls. They revised that down over the past year by over 800,000 jobs they claimed were created, but were not. Now, tomorrow is going to be the last day, or the last report, I believe, before the election. And it really is going to be the last meaningful report tomorrow, because people are already casting votes. Voting has already begun. So it's critical for the regime to stay in power to have a gangbuster number tomorrow. My guess is that it's probably going to be a gangbuster number, and they'll revise down that number next month after the election. Now, if they report a weak number tomorrow, wait for that revision, because if they're willing to report a weak number in front of an election, look out below for this market. Because again, let's do this. Let's do this. Let's overlay the S&P 500 Well, there's no, let me do it. What are we doing here? All right, it's not letting me do it. Sorry, folks. It is not letting me overlay. Usually I don't have a problem, but I can guarantee you that when jobless claims roll over, the stock market goes the opposite direction of where most people want it to go. So it's critical that this number come out positive for the regime tomorrow. Now, there's a problem for the overall economy. Forget about the election. The problem with the overall economy is that while we have the unemployment, total non-farm payrolls is a lagging indicator, whereas unemployment rate is a leading indicator for the economy and recession. There's another indicator out there called the JOLTS report. And the JOLTS report is basically job openings. And you can see that we skyrocketed up higher after COVID. And that's for a couple of reasons. To be fair to the regime, you had about 2 million people that never came back to the workforce. They just said, you know what, I'm done. And a whole bunch of other people didn't want to work because they were living off of stimmy checks. So you got this big burst in job openings. People just couldn't look for labor. But you can see now that the trend ever since March of 2022, over 2 years now, has been clear. It's been defined. It's been going down. Job openings are declining and declining dramatically. It's in a bear market, if you will. So coming out of recession, take note of what happens. This looks very similar, right? Stair stepping down, double bottom setup, and then we go into a new bull market. So the reason why I'm going over this is not because of an election. It's to show you where we're at using leading indicators to show you that this market is a very, very dangerous place to be right now. And I'll tell you straight out, I think that the weekly charts and the monthly charts look fairly bullish, and in all probability, we're going to continue up higher. So much so, I hedged my shorts. I'm still short. I hedged my shorts last week. But we will not put blinders on to the fact that we have some real serious problems here in the jobs front. And at some point in time, it's going to come home to roost. Now, let's talk a little bit about, I want to save the software sector till the end. I want to talk about some of the major averages and how they're looking on a weekly time frame. And I want to talk about sentiment indicators as well. So we're going to kick it off with the bullish percent index. And this is a weekly view. So this range here in green shows you, you're kind of getting to traditional median oversold levels. And then you have your dramatic oversold levels. And you want to be buying stocks down here when bearishness is at its worst. June of 22, September of 22, October of 23. That's the current bull market we're in right now. So this is when you want to be buying stocks. But the problem is that we're far closer to sentiment being extremely overbought rather than being extremely oversold. You normally don't get, this is a great visualization to show you how fear is a far greater motivator than what is greed. Because you don't get spikes higher through this upper band of resistance to this level 3 times, 4 times to the upside. You saw it back here, slightly, here, slightly. I mean, nowhere near in comparison to the downside move. So beware that the sentiment indicators are somewhat overvalued. They can go up higher. I'm not calling a top to this market by any stretch of the imagination. So just be aware of where we're at current. CRB commodity index. Well, we knew that when the Fed chair cut rates, he was going to let loose the hounds of inflation. Now, this is not updated for today. Let's update this for today. This is still not updated to reflect today. But oil was up big today. Natural gas was up big today. We've broken out. We were down here when the Federal Reserve cut rates, and now we've broken out. Commodities are ripping through the ceiling, and they're going to go up higher. Why? You got war in the Middle East. You got Houthi rebels shutting down the Red Sea. You got a longshoreman strike that's still going on. The longshoreman strike is equivalent to what happened to the markets during, or the economy during 2020. Supply chain disruption. Not to as great of an extent, but supply chain disruption nonetheless. Let's say hello to folks who stepped in. Hey, Franklin. Welcome, my brother. TZ Burton, welcome. Folks, don't forget, enter your symbols in the Bulls and Bears banter feed, and I'll get to them later on. Now, I want to take a quick look at the CRB Commodity Index monthly chart. You want to talk about breakouts. Holy cow. So we've broken out here. There's going to be major resistance on the CRB Commodity Index up at around 290. But this is pretty concerning. It's pretty concerning. Now, the dollar has been strong of late, so I'm very convinced that this would be a lot worse, meaning stronger, were it not for the dollar rallying. We're going to go to that chart in a moment. Let's talk about the yield curve. The yield curve is down on the week. It was lower. It's pulled back up a little bit. We're down about 5 bips. Let's take a look at the monthly view. And last quarter was just a monster quarter. So the yield curve ripping up higher. This all ties in. Think about the charts I just showed you from the St. Louis Federal Reserve about the JOLT survey, about job openings, and the unemployment rate. Both are leading indicators of the economy. So is the yield curve. Short end debt is yielding less now than what it was a couple of months ago, where the longer term debt is moving up higher. Now, the problem for the Federal Reserve is this, is that they want to bring down mortgage rates so that people refinance their mortgages and they can stimulate the economy by people buying new homes, blah, 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 blah. That's inflationary in and of itself. The problem is this, is that they're going to kill the dollar. What they're going to do is they're going to kill the dollar. And what's going to happen is, let's go back to this chart here. The Fed's balance sheet. Here's the max view of the Federal Reserve's balance sheet. So while they've been unwinding a lot of debt, you got to wonder to yourself, why are they so aggressive? They've been really aggressive with unwinding this balance sheet. Bravo. Bravo. The reason why they need to unwind this balance sheet as quickly as possible is because they know that at some point in time, keep this picture in mind. As a matter of fact, let's bring this. They know that at some point in time, the world is going to say, we don't want your debt. You guys are effed up. You guys are out of your minds. You're creating wars. We could have stopped the Ukrainian war. We could have kept Iran in check. We didn't. What are we doing? We're sending money out. We're sending money out to help finance these wars. Also, we have a government where we just had a major catastrophe, one of the worst hurricanes in history. And the reason is that it went so far inland. So you would expect that FEMA would come in, Federal Emergency Management Assistance, whatever the A stands for, agency. There's only one problem. FEMA is broke. And you may be saying, well, where did that money go? Where did that money go? It didn't make its way over to Pennsylvania, that town in Pennsylvania where you had that railroad disruption, destroyed their town, poisoned their water. It didn't make its way over to the Maui fire folks who still can't get on their properties. What happened to that money? That money, to the tune of $150 billion, is being spent on supporting illegal migrants. So, unfortunately, they get, according to Kamala Harris herself, those people that have been affected by this storm get $750. Think about how the world looks at us. And would you want to buy our debt when we're now cutting rates yet again? So meaning the federal government wants the world to buy our debt. Yet they won't acknowledge the risk that comes with our debt. They won't acknowledge the fact that you have jobless claims that are rising. Our debt is through the roof. We have no fiscal discipline whatsoever. We have a government, if you want to call it that, that is so incompetent. You would expect them to be good custodians of your money? Like what happened to the Russians, what we did to their assets here in the United States, where we weaponized SWIFT, that's a US dollar payment system? No way. That's why the BRIC nations are rising up against us. We sliced our own throats. We sliced our own throats. I said it back then in 2022 when we did that, and now it's coming home to fruition. So the bond market at current is going down. So people may be saying, well, wait a minute, bond yields are supposed to be going down because the Federal Reserve is cutting rates. That's not the way it works. It's not the way it works. The Federal Reserve is able to control short-term debt. To control longer-term debt, what they need to do is they need to go out into the bond market and begin to monetize our own debt because nobody else wants it. Or we need so much money, the world can't afford to gobble up that debt. So they're at some point in time, the reason why they're going to need to, the reason why they're rolling off debt off their balance sheet is that they know this has got to balloon back up. And there's something called the law of diminishing returns. So think about it this way. We had a crisis in 2007. It brought us up here. We went into a bull market, yet they kept spending. Operation Twist, Operation this, that, the other thing. Look what happened with just COVID alone. We went from pre-COVID, because the debt was rolling off, pre-COVID, $3,780,000 to $9 trillion. So to get the same impact on the economy and the stock market, they're going to have to double what they spent already from here to here. They're going to have to go twice as much. And the world knows it. That's the problem. So what's going to happen to the US dollar? In 2025, I do not want to be long or near the US dollar. Right now, it's moving up higher due to the fact that you have a couple of events that are going on. One of them is you have longer term yields which are rising. Why are they rising? They're rising because where's my they're rising because a lot of the Federal Reserve's interest rate cut and its impact on the bond market was already priced in when he cut those rates. And then they expected a half basis point cut. Now it's only a quarter basis point cut. Add to that, you have the Middle East that's in shambles right now. So there's money rotating into dollars at current. You're not seeing the stock market break out anytime soon. You'll probably see a pullback in the dollar if and when the stock market breaks back out again. But right now you're seeing stalling action in the markets because people are waking up and they're saying, I don't know if I want to buy this market. I just don't know. There's too many ifs out there. There's too many questions, especially with October being a seasonally bearish month. But to be fair, September is a seasonally bearish month as well. But we did very, very well in September. So perhaps we're just digesting those gains for all I know. What else is a concern out there? Volatility. So volatility, they say it's not chartable. It's completely chartable. With one trading day left to go, has broken out this week yet again. Now, the VIX is notorious for failed breakouts. Notorious. So maybe it'll drop back down next week. You can chart the VIX. It's very, very difficult. You need to be, when you're expecting it to rally, you need to expect to be disappointed, which is a good thing. You want stocks to go up longer term. Let's take a look at the VIX from a monthly perspective so that we are, why is this so big? That's what she said. I don't understand why. All right. Let's go to a monthly chart of the VIX. And then I want to take a look at the quarterly chart for a reason. Now, a huge sell-off in September after a ruthless spike up higher. Now we're back above 20. This is a great environment for premium sellers now. We sold puts today on Microsoft. We'll be talking about that chart in a moment. Software is the topic of the week, the sector of the week. And we have a breakout. Oh, and we also sold calls on Ross stores, expecting them to break down, which they did because of the longshoreman strike. What else do we have here? Dow Transports. This is a weekly chart, folks. Not a 15-minute. At current, we have an outside reversal bar on the Dow Transports. We are trading at current below critical. I do mean critical support. And not just one support level, but two. Now, why is this chart so important? The reason is that we broke out the week before last. This week, at current, we are down below two critical support levels, one trading day left to go. For all I know, it's going to rally like hell tomorrow. I have no idea how it's going to close. We're going to go to a daily chart in a moment. But if we do close down below these two support levels, that's a breakout point failure, also known as a bull trap. Very, very bad for the equity markets. Daily chart. I mean, 3 sequential down days. Can we pop a par tomorrow? Volume has not been horrific. But keep an eye on the Dow Transports. And generally, as go the transports, so goes the Dow Jones Industrial Average, which on a weekly chart, it's got its own problems here. Take a look at your RSI. So we have been grinding up higher since around March. And now we are threatening a rollover here. And when you take a look at the price action on a weekly view, we're at current down below the lower band of the rising uptrend channel, slightly. One good day tomorrow and we're back above it. But we're in a dangerous place. We have not yet put in a new weekly higher high. To be fair, I don't think we put in a new lower low, 41,859. We did put in a new weekly lower low. 41,847. S&P 500 weekly chart. RSI grinding lower, money flow grinding lower, new weekly lower lows. Let's take a look at the monthly chart. Not horrific. Great month last month. Can this reverse? Sure. Trip Qs, of which we are short. No follow through after last week's pretty good price action. We did see a little bit of selling at the back half of the week. RSI broke out. Stochastics broke out. These momentum indicators. Volume thus far this week is very, very low. So for all we know, let's go to a daily chart. For all we know, we could be in a consolidation as noted by this bull flag setup. Very thin volume today. Let's go intraday view to get a vibe for how they close this out. And not a bad close. Not a bad close at all. They rallied it into the close, which I was kind of happy to see because I sold puts today on Microsoft because it had been down for the past 3 days and on a percentage basis, pretty serious numbers. It was down heavy. So I figured, you know what? We were testing the 200 period moving average. So I sold some puts, betting that we would get a pop in the coming day or two, and then I'm just going to be out. I'm not going to carry the position for very long because I'm very, very concerned about the overall market. But I do want to play it to the long side as well when we see opportunities. I'm not wedded to any one side. I don't care. I look at the leading indicators of the economy, and I look at the charts. And when I'm beginning to see weakness in the equity markets, as you should see when you see the economic indicators telling you, hey, we got problems here. We have serious, serious problems here. That begins to validate my thesis that the probable path of least resistance in the coming months is probably going to be to the downside. Now, to be fair, October, yes, is not a good month for the equity markets. However, November is the best month out of the year. December is one of the better ones out of the year as well. So we can't rule that out as being a factor in our strategy. So when you go into the new trading year, 2025, I think that the picture changes quite a bit. So as goes January, so goes generally the rest of the year. January is going to be one heck of an interesting month. Small caps. There's not much to be said here. Tom Lee, everybody a couple of weeks ago, oh, you got to buy the small caps, got to buy the small caps. Yeah, I said no. Why? Because we looked as though yields were going to press up higher. And if you have a yield curve, which is uninverting, I'm not going to want to put a position on the small caps. There's a statistic, yes, that small caps tend to outperform the markets 6 months after an inverted yield curve. I cede that point. But what happens immediately after, usually an uninversion of the yield curve, you usually get a heavy stock market correction. So while the small caps may lead us out of that correction, we still need to have the correction first. So we have a small cap position. I'm not going to sell it. However, I'm not going to add more right now. And with yields pressing up higher, the last thing you want are small caps. Now, technology, the bigger cap technology you can buy. Why? They don't need to go to the debt markets to borrow money. They can issue shares. They have cash that they could use. They're good. So that's why you see the triple Qs and the mega cap names outperform in a rising interest rate environment, whereas the small caps go into a bear market. They need to access banks for credit and renew that credit. So they're always borrowing, just like the utilities. Semis, not a bad week. Down, but not a bad week. Biotechs, I got stopped out last week, and thank God we did. So stuck by the stop. That was right around, I don't know where it was. I think it was here, and it reversed. Something like that. We're here. I forget what day it was. It was definitely higher than where we are right now. And it looks like we're going lower on the biotechs. Staples. I called this the other day. I said, I think that we're going to break down. We had a breakdown out of this wedge formation, check back, and then we have since collapsed. I think we go lower here. Staples are short. Discretionary names. Let's update this. I got so much noise on this chart. Let's get rid of this. Now, Staples, the XLY includes Tesla. So to be fair, Tesla is influencing to a certain extent this sector. However, the other day, Tesla was up and this sector was still down. So we're not broken yet, but we're pretty damn close. Emerging markets, this is inclusive of China. China's been closed. I still like this chart, though. We own EMXC. That's pulling back. So, once we get, we're going to go over tonight, but that's okay. Once we get the big sell-off in the market that we're looking for, there are a couple of areas that we're going to be buying and buying very aggressively, because what the Federal Reserve is going to need to do to bail out the U.S. government again is going to be, as I mentioned earlier, catastrophic for inflation. So once we get the big sell-off in the equity markets, what we're going to want to be buying are not U.S. stocks per se. We can nibble them, but that'll be a position. But we want emerging markets. We want gold. We want gold mining stocks. That stuff, because inflation is going up. It has to. They're going to kill the dollar. They're going to send inflation up, soaring, because they need to go back to the printing presses. Energy. Great week last week. Beautiful breakout. I wouldn't chase it, but I'd like to see a pullback to the support level. And if we do, I'll probably be a buyer, because this is a stair step up higher. The primary trend here is still up. We've just been in we've been in a bear market within the confines of a cyclical bull market. Crude prices. That's not inflationary. Don't worry about that. Don't look at that. No, don't look at that. We're up 8% on the week, over 8%. Gasoline prices. Gasoline prices are now up over 8.5% as well, and they are going up higher. So this is all going to be calculated into inflation, but the Federal Reserve conveniently backs out food and energy out of their inflation numbers because it hurts the narrative. Weekly chart of natty gas, natural gas up nearly 2% on the week. Not inflationary, don't worry about it. We're going to cut rates still. Let's talk about gold. Now, gold is stalled here because the dollar's going up, yields are going up. But once they begin to break, at least the dollar, if that breaks, you can get gold moving up higher again. Still longer term, very, very bullish here. But we've had 1, 2, 4 consecutive up weeks so far. We've had out of 9 weeks, 2 down ones. I think we're due for a pullback. Gold mining stocks, they're down 2.2%. But they have to consolidate gains. Let's check in with palladium, which we own. We bought it back here. It's come off of its highs, but it rallied. I know it rallied yesterday. I think yesterday. Let's go to a daily chart. Then we'll go to silver. Yeah, it rallied yesterday, pulled back today. Island reversal. I'm still going to stay long of it. I'm not going to buy any more. Silver, weekly view. This is a leveraged product. Let's bring up SLV. SLV is up on the week. I think it was up on the day as well. So silver getting ready to break out to new, Jesus Christ, new 52-week highs, new multi-year highs on silver. Buckle up. This is the commodity market speaking. It's saying inflation's coming. We have a lot of problems out there. This is the commodity complex is a beautiful thing. It tells you what's going on out there, where money is flowing. It's flowing into things that are not fiat currency. You can't buy, even though the dollar is up on the week, you can't buy the same amount of gold this week as you could last week. Why? Gold is up this week. So the purchasing power of the US dollar continues to decline relative to silver, relative to gold. Let's talk about software. So I was asked to do a review of this sector, the software sector, because on a year-to-date basis, the Dow Jones U.S. Software Index has it's basically half the rally, half the performance of the S&P 500. So how do we look on a monthly time frame? We had a good month last month. We had a bullish key reversal. We are in a very tight wedge formation. Momentum as measured by Stokes hooking up. RSI, though, making lower highs. No lower lows yet, but lower highs. Let's drill down to a weekly view. Weekly view, we're as soon as we hit that 7,082 mark, we roll over. So is this a buy? No. I'd rather pay more to be right. A close above 7,083 would be interesting. I would scratch the itch. Give me a close above 7,305. Obviously, this is the Dow Jones Index. You can't buy this, but you have ETFs that track it. So find that ETF and just watch this chart or just chart the ETF and apply the same rules to that chart. So I'm not a buyer here as of yet. And the other reason is that when you take a look at this ratio chart, Dow Jones software index relative to the S&P 500. Complete and utter laggard. It's still a laggard, and the S&P 500 is threatening to roll over. Now, I'm not a believer that the software sector is going to be the standalone sector that's out there that's going to rise with the S&P 500 going down. Laggards tend to lag. So if the S&P 500 continues to weaken up here, you should expect that the Dow Jones Software Index is going to correct as well. It's not an outperformer. So there's a couple of symbols out there that I want to go over. Folks are going to be using TrendSpider. They sponsor the show. 35% discount code. Use the link below on YouTube. Use the link above on Twitter, or just scan that QR code. Get 35% discount on TrendSpider. Automated technical analysis. I give it away free to our silver and gold level members. 14-day free trial offer. Link below. All right, enough plugging here. All right, so at current, Microsoft, I know this is noisy. Let's get all this stuff off. At current, let's do this. Okay. And let's take off the trend lines. This is the line we're focusing on. All right, so Microsoft, of which I happen to have a long position at current, but again, a very, very short-term trade here, scalping in and out, because it's been down for now 4 consecutive days, and it's off of support at current. We'll go to that in a moment. At current monthly chart, we're only 3 days in here, so don't read too much into this. We are trading down below the lower band of support. We did the same back here in August. We did the same back here in September, only to close back above it. No reason to believe that that's not going to happen again. All right, so we're not using the monthly chart to say, okay, this is the direction I think that Microsoft is going to go. If we close down below this current support level in white, that tells me going into next month that we'll probably get a check back, a rally on Microsoft, only to expect a break going into the new year. Now, on a weekly time frame, we have a different set of problems. We have a new support immediately below. We have now a triangle formation. Can Microsoft muster enough fuel, rocket fuel, to rally back to recapture 423 per share, consolidate, and then break us out? Because as goes Apple, as goes Microsoft, so goes the triple Q names. And here's the daily view. I think we're going to pop tomorrow on Microsoft, because this chart is telling me that we are in a wedge formation and at support. So short-term bullish on Microsoft, longer term, I'm very concerned. Also, when you take a look at the weekly chart, I forgot to go over this. I want you to take note of the lower highs. So when do we know that Microsoft's in a lot of trouble? Well, if we continue lower here and we break down below the lows of August at around 386 per share, that's it. It's game over. New bear market for Microsoft for a while. We're not there yet. We're not there yet. It's a good time to sell sell calls on Microsoft, or a Iron Condor, or Strangle, whatever you're into, and generate cash flow until this gets resolved. We don't know which way it's going to go yet, but it's under a lot of pressure and has been for a while. Now, other names that we wanted to go over were Cloudflare, internet security. How are we looking? It's been a laggard. It's been a laggard. I mean, great stock to sell premium on because it's doing absolutely nothing. It's trading within a range on a monthly time frame. So, am I a buyer here? Not into earnings. I wouldn't want to take the risk. But I would be bullish on it by selling puts, meaning selling a 70 strike, a 75 strike, then at the same time selling an out of the money call option as well to offset that and just generate cash flow. Why? Because you have volatility. The VIX is above 20. Great time to sell premium. Datadog. What's that symbol again? TG? What's Datadog? I don't think I've ever analyzed this stock before. DDOG. I should have duh. Duh. DDOG. Datadog. This is looking interesting. This is a weekly chart. Let's see how they closed out the month. Bear market. Hello, I want to drag you down. All right, get rid of you. Here's your range on Datadog. Between 138.55 to the upside, 96.35 to the downside. Right now, this is another stock in the software arena that I would be okay. Sell premium on it, make some money, generate cash flow. Is the chart bullish? I wouldn't necessarily say that, but it's certainly not bearish. You know, what we've done here is that we've stopped going down and we've begun to put in higher lows. In fact, this is a pretty good setup back here. Nice breakout. When would I be a buyer? I don't like this here. It's like a wedge formation. We break this. It's coming right back down here again. So I'm not a buyer yet. You give me a breakout and a close above 120, I'd be a buyer of the shares, I'd nibble, and then I would be more aggressive up here in a breakout and a close above 139 per share on Datadog. It's definitely not a short. Now, the other name I wanted to go over was Palantir. My dad loves this stock. Loves this stock. Now, to me, Palantir is way too overbought. Way too overbought. You have RSI, it's 75. That can still go higher. We're right at the upper band of the rising uptrend channel. I'm not a buyer here. I wouldn't do it into earnings, but I would probably sell a call spread. And you could even do a put spread, creating a strangle or an iron condor. That would be a great trade. I would not short this stock. Yeah, maybe let's drill down. Let's take a look at the daily chart. No, I would definitely not short this stock. It does have a little bit more upside before it hits that upper band of resistance, Volume today was very, very good. I mean, wonderful price action here. Out of the software stocks so far, Palantir clearly the leadership name. Now, CrowdStrike did not have good earnings last quarter, and it was punished for it. Now, there is support at which we recaptured this week. We're back above it. We had broken out, pulled back, retested again this week, and now we're back above it. So good stuff in terms of price action on CrowdStrike. Here's where we broke out. Wedge formation or downtrend channel, whatever you want to call it. We've broken out. I'd like to see another day or so trading above the support level. Volume could have been better, but it's looking pretty good. Let's go to the members area. We're way over tonight. Let's see. What do we have here? SMCI, AWR. Did I miss anybody? Sometimes I do. Okay, no, I did not. AWR. I need to go so AWR. I'm not familiar with this company. We went through a bear market. I'm a buyer and a close above $86 a share. You'll note this is a monthly chart, so the topping tails are showing you all the wicks, shadows, call them cupcakes. It doesn't matter. What these wicks imply is that you have sellers above. So, and you already see it this month as well. But as time goes by, the probability each time we charge this resistance level, you're going to have less and less sellers up there. So the probability of us breaking out grows. Let's go to the weekly chart. I'm not a buyer here yet. Not yet. Premium seller, this is probably very illiquid options market, so I probably wouldn't do premium here. This is in no man's land right now. I would not initiate a position, long or short. No man's land. It's got to break out. SMCI. Have they filed their 10Q or what? Here's the weekly chart. Oh, they split. I thought I heard rumor they were going to put that on hold. I'm not a buyer here. I wouldn't short it because once they report that 10Q, then you're gonna get a rally here. And this thing, when it rallies big. So I would not short it yet, but I might. Well, look at the Bollinger Band squeeze on a daily chart. Bollinger's in red inside the Keltner channels. This thing's going to fire off big in one direction or the other. We just don't know which way yet. The fact that it's trading down below the moving averages, as well as the fact that the primary trend at current is down, leads me to believe that we will move lower on SMCI because weak stocks tend to get weaker. So that is my take on those stocks. Let's go to comments. Likely Netanyahu will target Iran's oil and nuke fixtures soon. I read that, and I think that we're backing that as well. That's when oil and VIX shoot higher and the stock market takes no dive. Agreed. It's a water company. Okay, so it's a utility. Gotcha. You're welcome, Sean. Hey, folks, thanks for being here. Don't forget, TrendSpider 35% discount code below. I give it away free to our silver and gold level members. And like, subscribe. You know the deal. And don't forget, please join our trading community. A lot of good people here. When you do join up, make sure you just say hello. You have the feed where I post some of our trades. And this is all real time. These are the real trade confirmations. So lots of transparency. Good week thus far. Here is the chat room. So we're going to be building this out quite a bit. More to come. And everybody have an awesome night. I'll talk to you soon. Like, subscribe. You know the deal. Share with a friend and your aunt and your uncle. Talk to you soon. Be well.